deficits exploding higher, macro alarmists coming out in droves to finally proclaim this is it. This is finally the point in time where deficits have just gotten too big and there's no coming back. Major consequences down the line because of the major spending that the U.S. is doing. Are they right? Should we be concerned? Is this finally the beginning of the end? Of course not. Of course not. Just like they've been wrong for the last 200 years, they once again will be wrong. Why? Because they don't understand just some basic accounting and the basic mechanics of what government spending is, what government debt is. Yikes, they have it wrong. They're going to be disappointed again. Lucy, once again, is going to snatch that ball away from Charlie Brown just as he goes to finally make it through the uprights. All right. We're going to discuss all things monthly Treasury Statement. The monthly Treasury Statement for the month ending July 2024 just dropped earlier this week. And a massive deficit, $244 billion for the month of July. Fiscal year to this point so far, $1.5 trillion. Government spending is big, in part because of what the Federal Reserve did now almost 2 years ago, or I guess a little over 2 years ago now, when they increased interest rates to the 5.5% that they're currently at, or the Fed funds rate at 5.5%. Bringing the total for, again, this is just for the fiscal year through the end of July, total net interest payment being $763 billion, a massive increase from where we were at in years prior at the 0% interest rate. But suffice to say, very, very big deficits. And again, the macro alarmists, all the names you know and love, coming out saying, this is it. Inflationary spiral, although ironically, as I'm recording this, CPI came out once again lower than expected, continues to shrink. We'll talk about that in the next video. For now, we're going to focus on the deficit. So what is the implication of this? And is maybe deficit spending slowing as well? Definitely some in the MMT camp are saying, hey, maybe we might want to project out that deficits are going to start slowing here. What's the implication going to be? What do we make of all this? That's what we're going to discuss in this video. Before we get into the nitty-gritty, though, if you're new here, make sure you hit subscribe, get that notification bell turned on. If you're watching this on X, Twitter, follow me there as well. And if you find this video particularly helpful, give it a thumbs up on the way out. So what is deficit spending? What does it mean when the government is in a deficit, is spending via deficit? What does this actually mean? I mean, I think what most people get wrong is I think what they think is happening is the government is somehow borrowing from the private sector to fund the provisioning of itself that it needs to do. In other words, that it's taking the financial assets out of the private sector to then pay for the real assets that it's going to acquire with those financial assets. And I think that's what most people think when they think deficit spending, because certainly if you or I were to go into a deficit, it would mean that we're using some form of debt to acquire goods and services. And so I think intuitively that's what we think. But we are not what the government is. The government is a currency issuer. We're a currency user. We have to go work for the currency, and the government is in this interesting spot in a macro economy where they're the ones that are actually creating the money and using it to provision itself. And the term I just used is really the best term to use. They're creating the money. Now, because of various rules and regulations over the year that get established, the government does have to finance its debt through the issuance of treasuries. And that's what we're going to discuss tonight, because when they do that process, we get it in our heads, or it's very easy to get into our heads, that the government is actually borrowing the financial assets out of the private sector. When you realize that what the government is actually doing is adding financial assets to the private sector as opposed to removing those financial assets out of the private sector, you understand why actually deficit spending is kind of a bullish thing for markets and growth. So that's what we're going to discuss. To get this, though, this might be boring. Listen, it's going to come off as boring. I literally have balance sheets on the screen right now. I understand this, but if you're willing to wait to the end, the payoff is worth it, because hopefully the light bulb will turn on, it'll click, you'll get why when the government's spending, that's a net financial add for the private sector, and that if you are someone who is investing, who wants to know where the macroeconomy is headed, why the impact of all of this ultimately is bullish for the longer-term macro outlook. So let's set up this scenario. We have a scenario where the private sector has an asset. It's going to be a tank, and the government wants to buy this tank out of the private sector. It wants to provision itself. It wants the tank. How does it pull this off, right? So it's ultimately going to pay the tank maker for this tank. But in this instance, the government has no money to spend, right? How are they going to pull this off? Well, Right now, if this scenario were to ever play out, there is a massive institutional structure with reverse repo markets in place where the government could go out into the private sector and momentarily obtain the necessary reserves to pull this off. But let's just say none of that exists. What would happen in a scenario where we are effectively in day one and the government wants to pull this off, but we're also in this world where there's a central bank and the government can't just spend without money, it has to finance itself? What would actually happen is it would just go into an overdraft. That's exactly what would happen. It would still instruct its central bank to go ahead and mark up the reserve accounts of the bank, of the tank maker, and then it would just provision itself. So what I want to show you is exactly what just played out here. In step one, before any financial transactions took place, we still had some private sector financial activity. So there were deposits and loans in the private sector and the commercial banking sector. There are deposits and loans as well. And what you'll notice is the net worth of the private sector as a whole is zero. This is really important. So at this point, there are deposits, there are loans that are the accounting record for prior economic activity. The private sector has this tank, and then what's going to happen in step two is now the tank belongs to the Treasury. And you'll notice that the private sector has increased its deposits without increasing any of its loans, and therefore its net worth has increased by $100. The commercial bank now has these reserves of $100 on its books, increasing its deposits as well to $200. And the central bank has allowed an overdraft of the Treasury to go ahead and occur momentarily. This is going to be the key part here, momentarily, also increasing the total reserves in the system. And so now there is money. There are reserves in the system. The Treasury has provisioned itself with the tank. It paid for it with these, ultimately the reserves that end up in the commercial banking system. The private sector has a claim on those as deposits. And we're all happy, except we now need to finance this debt legally, right? And this is where deficit spending comes into existence. Right now, we need a way to finance this this spending that we ultimately call the government debt or the national debt. And this is where now the government is going to issue bonds to finance the spending. And what you'll notice is what ends up absorbing the bond now into the private sector are those reserves that were on the commercial bank's balance sheets. So now the private sector, instead of having reserves, they have bonds, and the Treasury now has a debt, the bond debt that is now what was or now offsets the reserves that used to be out there. The central bank no longer, or the Treasury is no longer running a overdraft at the central bank, and everything aligns. So what do we end up with? We end up with a private sector that still has a net worth of $100. That net worth equates to the bonds, the debt that the government issued. So the net worth of the private sector is the government debt. It has a net worth. It still has the loans that were already created prior, but it now has a higher net worth. And just some knock-on effects of this, the tank maker created a revenue and likely created a profit, which means the bank is going to be even more eager to create a loan for the tank maker to go ahead and make the next tank. The private sector also now has a net worth that it can leverage from, and this now creates economic activity. So what did we just learn in this very admittedly kind of simplified version is that when the government spends, even when it deficit spends, ultimately what it's doing is it's adding net worth to the private sector, and the private sector uses that first as its profits to then generate new loan demand and then ultimately new income, and it also capitalizes, it creates the net worth base to go ahead and leverage from. So all the worrying about the deficit spending that came out earlier this week when the monthly Treasury statement dropped is just misplaced. It is just people, macro alarmists who don't understand some of the basics of how the macroeconomy functions. They continue to dismiss exactly what MMT has been saying for many, many years now, that it's just a very simple equation. That when the government spends, it adds financial assets to the private sector. And I can show this. I can prove that this is exactly what happens, and this is exactly why things play out the way they play out. If we just actually bring up the flow or the rate of change of deficit spending over time, you end up seeing that when we go into negative deficits, when deficits stop and reverse and they actually become surpluses, so they are this in reverse where they are actually pulling the bonds out of the private sector, they're removing the net worth out of the private sector, what happens? We go into a recession. That that system last very, very short before we get to a recession. We saw this in the 1970s. We saw this in the 1980s. We saw this in 1991 before the dot-com bubble. We got in that territory before the great financial crisis in 2022. All times where, for various amounts of time, we reversed the normal process of the government spending, adding those financial assets out. And it's a very simple idea once you understand how the balance sheet operations take place. You're taking the net worth out of the private sector. The private sector still has loan activity that it has to manage, it has to pay back, and you're literally taking the money out of the private sector to facilitate the payment of the very loans that the private sector created to create the economic growth to begin with. You're just setting yourself up for absolute failure when you get there. So quite literally, the vast majority of the macro alarmists have it 100% backwards. It is just completely backwards in terms of how they understand what government spending is doing. We are never going to get into a financial crisis in the sense of a complete collapse of the U.S. economy by adding too much deficit spending. Now, could there be inflation effects? Absolutely. But in terms of a disinflationary spiral of some sort, it doesn't happen that way. It happens the opposite way. So all this to say, big deficits put a smile on this bull's face at this point, and I will one day get bearish if and when deficits start to go negative, but we're just not there yet. Now, there has been some concern that deficit spending is starting to trail off, and certainly from the massive acceleration, and I should probably pause here for a second. I like to look at the rate of change of deficit spending, inflation adjusted year over year, as opposed to just the nominal value of the deficit at any given time. This really gives you a better look at the underlying flow. And certainly from a system dynamic standpoint, it's really most important is that acceleration function as opposed to just necessarily the change month over month. We're really looking at understanding the flow and kind of the acceleration of that flow. With that in mind, we did have that massive acceleration that took off starting at the end of 2022 and into early 2023, which really is the reason why we were so bullish in 2023. And certainly into 2024, we started to see a bit of a slowdown, but that is a natural process of just the way acceleration works. You end up getting this deceleration, and really where we would end up being very concerned is if we were to start to see something like we did in 2000, heading into 2008, where we saw a consistent push lower and lower over time. Now, as it stands, we just got the monthly Treasury Statement earlier this week and the inflation data today, so we can calculate where we are currently at on this trajectory. And in fact, from last month, we are actually slightly accelerating in terms of deficit spending. So no real surprise that, in fact, in July, we did end up hitting new all-time highs in the stock market before we got the big drop-off that we saw at the end of July and into the beginning of August. But suffice to say, from a longer-term macro perspective, I am seeing a good settling in of where deficit spending is at, and it looks like what will likely play out, all things being equal, is something similar to what we saw in the 2010s, where we get this extended period of relatively stable deficit spending sideways before some sort of exogenous event comes in. Now, there are some things that can absolutely change that. One of those is going to be what the Fed will do for the next rate change. Most likely a cut, most likely 25 to 50 basis points. That could absolutely put an end to the massive interest income that has been hitting the private sector, or at least start to slow that down, which in turn would slow down the rate of change of deficit spending. But until that happens, deficit spending remains relatively strong, and certainly as inflation stays in check, the potency, if you will, of each new dollar coming out into the private sector remains quite strong. So overall, look, we don't have much to worry about right now in terms of we have nothing to worry about in terms of the rising deficit. The big worry is going to be when deficits start to slow down. That is when we should start to get concerned, because that is the first domino that needs to fall to start the end of the business cycle. And at this point, we are just not there. So yeah, pay very little attention to the macro alarmists that come out expressing concern over the quote unquote massive deficits. This has been a game that has been played for many a year in terms of constant worry about deficits. I love this Time headline from 1972. I don't know if you can make it out there if it's too blurry. Is the U.S. going broke? I will point out in 1972, the entire national debt was right around $450 billion, and our deficit for the month of July 2024 was about half of that. So we are, in just 1 month, creating the total amount of debt that was in place in 1972. And of course, we have increased by about 35 trillion since then. And certainly since the great financial crisis, we have increased by many, many trillions that people have been very concerned about. And since the great financial crisis and really the massive acceleration that we've seen in deficit growth, despite that one blip from the first global pandemic that we'd seen in a century, there has been no recession. There has been no economic crisis. In fact, you could really say the last 15 years since the great financial crisis has been one of the least volatile, most kind of tame economic growth periods, given the exogenous circumstances that took place in the middle of that. Yeah, you can really just say that, in fact, deficit spending very much, or accelerated deficit spending very much, aligns with a decrease in overall volatility from a macro perspective. So once again, pay little attention to the macro alarmists who get overly anxious about rising deficits. They just have them completely backwards. All right, but that's what I have for tonight. If you like this type of research and analysis, you're an active trader, active investor, make sure you head on over to appliedmmt.com. You can get all the tools that we build over here, all the research, all the analysis, updates every single week in terms of where we are at as a whole in the macro economy. So check us out over there, appliedmmt.com. Otherwise, until next time, good trading, everyone, and we'll talk to you then. Bye-bye.